When traditional income verification makes property investment seem out of reach, DSCR loans are reshaping U.S. real estate investing by allowing investors to qualify based on property performance instead of personal income. On Real Estate Capital and Growth USA, we explore how this transformation is redefining opportunity in America's property markets. Today's real estate landscape in the U.S. is no longer solely driven by credit scores or pay stubs, it's guided by property-generated cash flow. This shift is changing how Americans invest, scale, and grow their portfolios. Before we move forward, let's take a look at the disclaimer. This video is for educational and informational purposes only. It does not constitute financial, legal, or investment advice, and no guarantees or promises of results are implied. Always perform your own research and consult qualified professionals before making any investment decisions. Now, let's begin by understanding what DSCR means and how it shapes financing across the country. The fundamentals of DSCR mechanics. Across the United States, DSCR loans are reshaping U.S. real estate investing by redefining how property performance is measured and understood. The debt service coverage ratio, DSCR, has become a central concept in modern property financing, focusing not on a person's income, but on the property's ability to sustain itself through reliable, consistent cash flow. In today's U.S. housing market, where rental demand continues to expand in cities like Dallas, Atlanta, and Miami, understanding DSCR mechanics helps explain why this metric has become a trusted indicator of property strength rather than personal wealth. Let's explore how this ratio is calculated, what it represents, and how it aligns with real estate trends across the country. How DSCR is calculated. The debt service coverage ratio represents the relationship between a property's net operating income, NOI, and its total debt service, or the payments due on its mortgage. In practical terms, it measures how well a property's own income supports its loan obligations. For instance, a DSCR value of 1.25 indicates that the property earns 25% more than what is needed to cover its debt payments. This metric offers a neutral, data-based view of property performance, an approach that aligns with a market increasingly focused on asset sustainability rather than personal income. To see why this ratio matters so much, it's essential to understand how it evaluates property reliability in real-world U.S. markets. The role of property cash flow in evaluation. In today's data-driven lending systems, property cash flow stands at the center of the evaluation process. This approach helps assess whether a property can maintain steady rental income to meet its obligations without depending on the borrower's employment history. In states like Florida, California, and Texas, where the rental housing sector is expanding rapidly, DSCR-focused analysis helps describe a property's financial rhythm rather than its owner's background. It highlights operational stability, which makes it a fundamental indicator of property resilience across different market conditions. Let's look at how this property-centered approach has helped redefine the concept of reliability in U.S. real estate financing. DSCR is a reflection of market adaptation. As real estate markets evolve across the U.S., DSCR-based evaluations reflect a broader shift toward performance-centered lending. By focusing on property-generated revenue, this model captures the economic health of investments across diverse markets, from suburban single-family rentals to urban multifamily complexes. It provides a consistent framework for describing property viability without offering any form of financial or legal advice. In cities like Charlotte, Houston, and Tampa, where demand for rental properties remains strong, the DSCR model provides an informative picture of how real estate financing is adapting to a changing economic environment. Now that we've explored how DSCR mechanics function, let's summarize what makes this model such an important element in today's property evaluation systems. The fundamentals of DSCR loans are reshaping U.S. real estate investing by showing that success in property financing depends on asset performance rather than borrower profile. Across the U.S., this approach aligns lending evaluations with tangible property results, offering a consistent way to understand how buildings perform in the marketplace. Rather than focusing on personal income, DSCR metrics bring attention to cash flow integrity, helping illustrate how real estate continues to evolve within data-informed frameworks. This educational exploration emphasizes how financial systems analyze performance, not to provide advice, but to describe emerging trends in U.S. property assessment. Next, we'll look back at how this transformation began and how real estate financing shifted from traditional income verification to cash flow-centered evaluation. Historical shifts in real estate financing. For most of the 20th century, real estate investing in the United States relied on a rigid structure, tax returns, credit histories, and employment verification defined who could buy property. This framework made real estate seem exclusive, favoring those with traditional income proof, while limiting independent investors and small business owners. Today, the landscape is changing, powered by data-driven lending models and property-focused analysis. These modern tools give lenders new ways to measure financial reliability, shifting the focus from personal income to the performance of the asset itself. This transformation represents not just a financial change, but a cultural one within American property markets. Let's now explore how this evolution began and what it means for investors across key U.S. regions. The evolution of lending. For decades, American lending institutions built their systems around risk reduction through predictable paperwork, credit scores, W-2 forms, and tax filings. But as markets matured, these static methods struggled to reflect the reality of diverse income sources in a dynamic economy. Emerging data analytics in real estate financing revealed a better metric: actual cash flow from the property. This was the foundation for the debt service coverage ratio, DSCR, a measure that looked at the asset's strength rather than the investor's personal finances. As the U.S. housing market expanded, from suburban growth in California to high-demand rental zones in Florida and Texas, lenders realized that consistent rental income could, as a reliable indicator of repayment ability. This opened doors for investors managing short-term rentals, multifamily properties, and build-to-rent portfolios. Through DSCR-based lending, access widened beyond conventional borrowers. It helped investors focus on sustainable property cash flow, enhancing the accuracy of real estate valuations across the country. This transition from credit-based to performance-based financing didn't happen overnight. It reflects decades of trial, innovation, and adaptation. Today, DSCR financing forms part of a more inclusive system, one that aligns lending with real-world market potential. As technology continues to refine property analysis, investors now gain insights into cash flow trends, regional housing demand, and portfolio scalability, reshaping how the next generation of Americans build wealth through real estate responsibly. The history of real estate financing in America tells a story of adaptation and innovation. From paper records to property data analytics, each step has made investing more accessible and performance-driven. The rise of DSCR loans demonstrates that the strength of a property's income potential can redefine opportunity across the U.S. market, from Texas suburbs to New York high-rises. This journey continues to evolve, shaping a lending ecosystem built on transparency, data intelligence, and measurable performance, a model that reflects the future of property investment in America. Impacts on single-family investment strategies. In today's U.S. real estate investing landscape, single-family properties have become a dynamic testing ground for DSCR loan applications. Rather than focusing solely on credit scores or tax returns, investors now analyze the rental performance of individual homes as the foundation for their financing strategy. This evolution has reshaped how property investors assess risk, and opportunity across cities like Dallas, Miami, and Phoenix. The result is a model where financial approval aligns with real-world rental success, evaluating occupancy rates, local demand, and property yield instead of personal income documentation. Now, let's explore how this transition influences modern single-family investment approaches across the U.S. A new lens on investment viability. Across the U.S. housing market, DSCR lending introduces a performance-driven perspective on single-family investing. Properties are no longer judged by the buyer's income, but by how effectively the property generates rental income, compared to its mortgage obligations. This shift empowers investors to scale portfolios responsibly, emphasizing rental yield and cash flow stability in regions like Florida and North Carolina, where rental demand remains consistently high. Reinforcing portfolio growth through data. By focusing on measurable income data, investors now identify single-family homes that align with their cash flow goals and regional housing trends. This data-driven model reduces the subjectivity of traditional lending and strengthens property evaluation accuracy. In states like Texas and Arizona, where job migration and population growth remains strong, rental-based qualification allows for faster reinvestment of earnings into new acquisitions, fueling portfolio diversification. Sustainable single-family investing in modern America. This performance-first approach promotes sustainability. Instead of speculative buying, investors now focus on cash flow reliability, maintenance control, and property longevity, key elements for stable returns. The concept encourages responsible real estate scaling, aligning with U.S. market realities. As more single-family neighborhoods integrate smart analytics and rental tracking tools, DSCR-driven insights help create a clearer picture of sustainable long-term growth. The influence of DSCR financing in single-family real estate investing reflects a profound shift in how opportunity is measured across the United States. By focusing on property-generated income and occupancy performance, this model redefines access to financing while promoting informed, data-backed decision-making. From the suburbs of Atlanta to the coastal communities of California, investors are now engaging with properties as living financial ecosystems, each defined by measurable outcomes rather than static documentation. As technology continues to merge with housing analytics, the DSCR framework stands as a symbol of responsible growth and innovation within American real estate investing. Influences on multifamily real estate trends. In the evolving landscape of U.S. multifamily real estate investing, DSCR loans are redefining how apartment portfolios are financed and expanded. Instead of depending on personal tax returns or income documents, these loans allow investors to qualify based on total property-generated cash flow. This approach transforms how financial institutions evaluate lending potential, particularly in cities such as Atlanta, GA, Phoenix, AZ, and Denver, CO, where urban development and rental housing demand continue to accelerate. As rental demand surges nationwide, data-driven lending enables more balanced investment decisions grounded in measurable stability rather than speculation. Investors, analysts, and property managers now rely on occupancy ratios, expense ratios, and rent-to-income percentages to assess long-term performance. Let's now explore how these trends shape multifamily growth, market competition, and sustainable expansion across the United States. Performance-based portfolio scaling. Within multifamily markets, DSCR lending encourages investors to scale responsibly by focusing on portfolio-wide performance instead of individual borrower income. Each property becomes a measurable financial unit, evaluated by its net operating income and occupancy sustainability. In states like Florida and Colorado, lenders increasingly prioritize buildings demonstrating predictable monthly cash flow. This model helps establish financial consistency across entire portfolios, allowing investors to pursue growth through measurable returns, rather than personal credit strength. Market competition and value differentiation. The rise of DSCR-driven multifamily lending has intensified competition in key metropolitan zones like Austin, Seattle, and Charlotte. Developers now design buildings optimized for operational efficiency, sustainable energy systems, and tenant retention, factors directly influencing DSCR calculations. This shift encourages greater alignment between investment strategy and community performance, supporting a new generation of multifamily assets centered on economic durability and social livability. Long-term stability and data transparency. Data analytics has become the foundation for multifamily sustainability. Property management systems now integrate real-time DSCR tracking, expense monitoring, and predictive occupancy forecasting. In major U.S. metros, this transparency enables strategic reinvestment and steadier portfolio scaling. Rather than focusing on short-term gains, multifamily investors increasingly adopt data-first decision models, ensuring stability through consistent rental income and proactive maintenance planning. The expansion of DSCR-based multifamily financing in the United States signals a mature stage of property investment, one focused on data accountability, sustainable performance, and market transparency. Rather than emphasizing borrower profiles, this lending approach highlights the property's intrinsic value and its contribution to long-term housing stability in urban centers like Atlanta, Dallas, and Los Angeles. By aligning modern analytics with responsible portfolio scaling, DSCR frameworks contribute to a stronger, more resilient multifamily sector, one capable of adapting to demographic shifts, market cycles, and community needs across the U.S. housing landscape. Broader implications for U.S. market strategies. Across the United States, the influence of DSCR-based financing extends beyond individual investments, shaping broader market strategies and regional property dynamics. In states such as Florida, Texas, and California, where population growth and rental demand remain strong, these loans redefine how investors evaluate opportunity. By focusing on cash flow performance rather than personal credit or employment history, the approach opens new paths to scalable real estate models. This change represents more than a financial trend, it's a nationwide evolution of how stability and value are defined within the U.S. real estate ecosystem. Urban centers, suburban expansions, and secondary markets alike are adapting to a framework built on verifiable income performance and consistent rental yield. Now, let's analyze how this shift is shaping investment behavior, regional development, and market resilience across the country. Regional shifts in investment logic. In Florida, DSCR adoption emphasizes rental stability and tourism-driven housing markets, where consistent cash flow often outweighs seasonal fluctuations. Meanwhile, Texas markets such as Dallas-Fort Worth are leveraging DSCR evaluations to support rapid suburban expansion, while California uses similar frameworks to encourage affordable multifamily projects in dense urban cores. These differences reveal how flexible, data-backed financing models can support distinct economic landscapes without relying solely on borrower credit metrics. Institutional and small-scale investor convergence. Institutional investors and smaller landlords are now competing in similar spaces, united by the cash flow first philosophy enabled by DSCR financing. This convergence has led to data-driven transparency, encouraging both groups to prioritize long-term occupancy stability, energy efficiency, and location-driven profitability. Across the U.S. Sun Belt, such as Arizona and Nevada, rental performance metrics increasingly determine valuation models, creating an even playing field where property performance dictates opportunity. Data, risk, and market stability. DSCR frameworks promote risk awareness through measurable performance indicators, strengthening confidence in the U.S. housing market. In regions facing affordability challenges, transparent property-level data empowers communities and investors to align around realistic, income-supported development models. As analytics improve, DSCR-based strategies are likely to enhance national housing stability, supporting long-term sustainable growth without speculative excess. The broader implications of DSCR financing extend beyond real estate investment. They reflect how American housing markets are evolving toward a more transparent, performance-oriented ecosystem. By focusing on measurable cash flow, regional market dynamics, and sustainable operations, DSCR lending reinforces long-term confidence across both residential and commercial sectors. From Miami to San Diego, Houston to Charlotte, data-driven real estate financing is creating a more inclusive investment environment grounded in stability, performance, and regional opportunity. The result is a housing economy shaped not by speculation but by the measurable strength of American property markets, a transformation that continues to define the future of U.S. real estate strategy. As we move through 2025 and beyond, the role of DSCR loans continues to evolve. Advances in data analytics, digital underwriting, and property performance tracking are refining how U.S. lenders and investors assess value. The result is a more accessible, data-driven model that aligns financing with real property productivity, rather than paperwork. This approach is shaping a resilient foundation for the next generation of U.S. real estate investment strategies. The landscape of real estate financing is changing, and DSCR loans stand at the center of that transformation. To keep learning about how data and capital are reshaping America's real estate future, subscribe to Real Estate Capital and Growth USA and stay ahead with our upcoming insights. Thank you for watching.